Tomorrow is your first paper.
Yes, it's MA and then PhD left for part two.
Okay. So how is the preparation going? Jemima said the things have become plenty.
It's true. It's true.
It's been tough. It's been tough. We are preparing towards it.
Okay, you are preparing, right?
Yes, sir.
Small like that. Small. Okay, so let's see. I'm going live as well. Okay, so welcome to the live stream today. And Jemima, hold on, I'm coming. So welcome to the live stream today. And I'm very much excited for having you. Day one, I mean, it's almost gone. Corporate reporting students have like 20 minutes, then they are done. But FR people, I mean, they are done. We've seen what exactly it is about that. So tomorrow is management accounting, and I want to come your way and answer any questions that you're having. So for those of you joining me on Facebook as well as on YouTube, for those of you joining me on YouTube as well as on Facebook, give us a thumbs up on the video and share the video as well. Let us reach a lot of students and assist a lot of students writing the management accounting paper in that case. And for those of you who are joining me on Zoom, you indicate by raising your hand, then I'll bring you up with any questions you have. It's a Q&A, I'm not teaching here. So whatever question you have, you hit me with it. Some clarity you want, you hit me with it. Then I provide you with some assistance in that case as we move on with our discussion. So let's see. YouTube, I see some of you guys coming up. You are welcome to the stream. Facebook, I see some of you joining also. You are welcome. Management accounting tomorrow, put in the chat box. I'm coming your way to answer your questions. So any questions you have, put it in the chat box, and I'm going to be answering any questions that you have. Sadiq texting, I see you with a thumbs up in the chat. Sadiq, I hope that you're doing well, and thank you for joining us on the live stream. So Zoom, I think, do I have some people's hand up? Yeah, Nancy, your hand is up. Come up, you can unmute and come up any questions for me.
Yes, sir. Good afternoon.
Good afternoon. How are you doing?
Very well. Ready.
How is the revision going?
Ready for tomorrow.
Oh, say yeah. Oh, say yeah.
So in capital budgeting, please, did you say that we should always use nominal cost of capital to discount the cash flows?
Relax. When you are doing the issue in relation to
the real and
nominal,
yes.
No, it depends on what exactly is going on in the question in that case. So, for instance, if you are giving cash flows in real terms, then you are giving the nominal cost of capital. Then you can use the Fisher formula to move from nominal to real cost. Then you can use the real cash flows to calculate the NPV of the project. But then if you are giving the real cash flows, and then you're also giving inflation for each of the items or even general inflation, and you're giving nominal rate of return, nominal cost of capital, then you can inflate the cash flows so that you can use the nominal cost of capital to discount the project. Does it make sense?
Yes.
Yes. So it's about choice, it's about alternative. Once the examiner didn't pin you down to use to calculate net present value for real cost of in real terms or net present value in nominal term, once he's giving you a blank check, then you can choose, do I have to inflate the cash flows and use the nominal, or let me use the real cash flow and then I would use Fisher formula to come and calculate the real rate. And each approach you adopt or use, it's going to be correct in that situation.
Oh, all right. So that's my beef.
Okay. All right, that is fine.
Thank you.
All right. Any other questions? For those of you who are with me on Zoom, you can indicate by raising your hand. If you have any questions for me to share my thought on, just indicate by raising your hand. I'll call you. Then I answer the questions for you. Tomorrow is management accounting. We want to make sure that we provide you with some assistance in that case. Then for those of you on YouTube and Facebook, also put it in the chat box for me. John Malongo said, hi, how are you? I'm fine, John. Capital allowance resulting from depreciation, how is it calculated? Right, so in investment appraisal. Okay, so let's see, maybe I have to share my screen with you. So let me bring up my screen real quick. Let me bring out my iPad so we can get some scribbling going on there. Coming up. Come on now. Edwin Ba on Facebook said, I'm late. Oh, you're not really late. So put in the comment section any questions you have for me. I don't know why my iPad is delaying to show up. Let me take it again. Give me a moment. Okay, coming up. Okay, we got it. So let me share my screen with you real quick, and then let's go into the question John asked under investment appraisal. Okay. So when it comes to investment appraisal, one of the key workings you're going to be doing, especially when you are in the NPV school of thought, is to deal with the issue about tax benefits, which is coming on depreciation in that particular situation. And the way you go about that, like I say all the time, so I'm going to pull up a scenario real quick so I illustrate to you exactly how that is done. So let's say that the cost of a project, is whatever, let's just say $10,000, okay? And let's say that the tax rate in the question, it's whatever, let's say 25%, the traditional corporate tax rate. And let's say that we told in the question that depreciation or capital allowance on reducing balance is whatever, let's say 15%. So this is the scenario, and we are calculating the issue in relation to the capital allowance that we are going to be using on the NPV schedule. I didn't bring the project live, but let's assume the project life is whatever, 4 years, maybe 4 years. And let's say the scrap value or the terminal value, it's also maybe $2,000. So this is the scenario we have going on there. And we want to calculate the capital allowance or the tax benefits in that situation. Like I tell you all the time, the examiner will say capital allowance on reducing balance basis is whatever. Whatever statement the examiner makes about capital allowance in the NPV question is not the capital allowance, because that is how the depreciation is rather calculated, because the capital allowance is on the depreciation. The capital allowance is always on the depreciation. So the examiner may say, like what I've just said here, capital allowance is 15% reducing balance. That is not the capital allowance. So you just have to be mindful on some of these statements. So how do we go about it? Let's see. We're going to have the year up. We're going to bring up the cost. We're going to bring depreciation coming up. And then we're going to bring the tax benefit here. So the way we go about this is the depreciation is the capital allowance thing that has been said, 15% reducing balance. And then the tax benefit is the tax rate given to us, 25%. So we go punch this out real quick in that case. So year one, we bring the cost, could slash in my currency signs real quick. So year one, we bring the cost that is $10,000. Let's get 15% of that. I think that would be 1,005. Then you take 25% because the capital allowance or the tax benefit is always on the depreciation figure. That's how you do the computation. So 0.25 by 15,000, that would be 375. 3750. Now remember, it's on reducing balance basis. So in year two, we're going to have 8,500. You subtract the depreciation from the cost. So 8,500 multiplied by 0.15.
So the tax benefit.
Hey, I think, yeah, there's a problem there.
The tax benefits is 375.
Yeah, thank you. So year two, 8,500, 0.15. That's 1,275. Then you take 25% of that. That gives you 319 approximately. 319 approximately. Then year three, reducing balance, 8,500 minus 1,275. We get in 7,225. So 7,225, you take 0.15 of that. I'm getting 1084 approximately. So 1084, we take 0.25 of that. I'm getting 271. Now in the fourth year, that is the last one. That is the area you want to make sure you understand what exactly is going on there. And that is where many people freak out when it comes to dealing with capital allowance and PV. Now in the fourth year, what you want to do is to bring up the net book value in that particular situation. Let me see if I have some people in my waiting room. Okay, I'm good. Oh, yeah, got somebody in the waiting room. Okay. So if in the fourth year, let's get a net book value, 7,225 minus 1084. That's 6,141. Now in the last year, assuming the question does not say, we don't have any scrap value or terminal value, all we're going to do is to just do 25% on the 6,141. And that would have become the capital allowance for the fourth year period. So assuming they say scrap value is nil, then in the final year, capital allowance will just be granted on that book value, meaning that in the final year, you don't have to calculate any depreciation before doing anything in that particular situation. So what do we do? In this case, per my illustration, capital allowance is 2,000. So if you check, the terminal value or scrap value is 2,000. So if you check it up, if you check, when we sell the asset, you less that 2,000 directly. So you get 4,141. Meaning that if you sell this asset, you make a loss because now the book value is 6,141, but you can sell it for only 2,000. So it means when you sell this asset today, you're going to be making a loss. So that loss, you claim an additional working capital, 25% on that directly, 4,141, boom. And that is giving me 10, whatever, let's say 1035 in that situation. And that is an outflow. So that is how you deal with capital allowance when it comes to the NPV schedule. Now, assuming the scrap value was more than the nominal value we had there in the final year, then that means if we should sell the asset today, we're going to make a profit. Since we're going to make a profit, that means we would rather pay tax but not get tax benefits. So in that case, the final one will be in brackets in that particular situation. So when it comes to dealing with tax benefits in investment appraisal, this is how you go about that. And that is a question coming in from John in that situation. And always know that if the examiner brings NPV, you have to know when is tax paid. Tax can be paid in arrears, that means that 1 year tax will be paid in the following year, or tax can be paid immediately. So you have to listen. The way your schedule will be determined will be based on how tax is paid. If you mix that, you're going to screw up everything. So if tax is paid in arrears, meaning year one, and the project is 4 years, you're going to add another 1 year, making it 5th or 5. So that year one tax will be in year 2, year 2 will be in year 3, year 3 will be in year 4, year 4 will be in year 5 in that situation. So 1 year will be added to it, and the tax will work with the capital allowance. So whatever tax that is supposed to be paid will come in that situation. Then your tax benefit, which is the workings that you did, will also come in line with that tax. So the tax paid will be in brackets, while the tax benefit comes in as a positive in that situation. So that is one thing you need to pay attention to. Once you are dealing with MPV, we don't know what the examiner is going to bring in. But once you are dealing with MPV, the tax, you must know when tax is paid. If it says immediately, then if it is 4 years, 4 years. But one thing you have to also be careful is that the fact that you've had a 5th year does not mean if there is a scrap value, you go and put it under the 5th year. No. That 5th year column, or that additional year column that you are bringing, is for the tax. Nothing, the tax and the tax benefits, period. So if assuming they said scrap value is 2,000, like in the case of this illustration that I'm working on, that 2,000 will still come in year 4. If there is a movement in working capital, and you know that all working capital outflow would have to come as an inflow at the end of the project, that will also be at the end of year 4. So the 5th column you are bringing here is for you to just deal with the tax and then the tax benefit, period. Nothing else goes into that additional column if tax is paid in arrears. So that is the issue about that. For those of you joining us on Zoom, give me, you can raise your hand if you have any questions, and I will bring you up and answer the questions that you are having. If you are having any question, you can just raise your hand and I'll bring you up with any questions you have specifically, then I can provide you with some answers there. For those of you who are watching on YouTube and Facebook also, you can put your questions in the comments section on Facebook, and then in the chat session or in the chat box on YouTube. I'm reading all of your comments and we'll be providing you with some answers in that situation. Tomorrow is management accounting, and that is exactly what we are focusing on. Blessing Malungan said, "Sir, I just joined. What are you doing?" I'm answering questions about management accounting. So if you have any questions on management accounting, you can hit me with it. George Ampofor said, "Please, do you have videos on MPV you are solving on your channel?" I don't think. I mean, we have over 500 videos already, over 500 videos on the channel. So I cannot recollect any specific thing, but you can check the playlist for financial management. Probably you could get some videos on MPV in that situation. Nana Dako Akono said, "Please, what is planned and operating variance?" It depends on where exactly you are looking at, but if you are discussing issues about variances, one of the things that you need to understand is direct material cost variance. I mean, the direct material cost variance can be divided into two broadly. That is the direct material price variance. Maybe let me deal with direct material usage variance and then the direct material price variance in that situation. Now, if the entity is using more than one raw material, then the direct material usage variance could be subdivided into the direct material mix variance and then the direct material yield variance. Now, with the price variance, if the organization also want to have a better understanding of what exactly is going on, why the price variance is adverse or it is favorable, then the entity may want to dig deeper to assess the purchasing department or the procurement department of the organization in that case. So in that case, the material price variance could be divided into the material price planning variance, the material price operational variance. The material price planning variance, which is where your question is, it's about assessing the ability of the purchasing department to be able to accurately estimate the price of goods and services or price of materials that we want to procure as an entity. For that reason, the material price planning variance is going to be your standard price in that situation, minus the general price as at the time that you are procuring the goods, all multiplied by the quantity of raw material that has been purchased in that period under consideration. So that is called the material price planning variance. If we want to assess their negotiation ability, how they are able to actually buy, whether they really buy at a higher price or at a lower price, that is where the material price operational variance is going to be coming into town, where you are looking at, hey, what exactly is going on there? So the material price operational variance is actually going to be equal to the general price at the time that we are buying the materials, minus the price actually paid, multiplied by the quantity of material that we have bought for the period under consideration. So if you ask me about planning operating variances, that is what you need to understand about that.
Sir, please, I can't see.
You said?
What you wrote over here.
Where?
The material price planning variance.
It's standard price minus general price.
So standard price minus the next one, I don't know what it is.
General price.
Material price plus general price.
Standard price minus general price at the time of purchases times quantity of material purchased. You good?
Yes, please.
Okay. Then someone is asking, sir, please, is transfer pricing the same as pricing decisions? No. Transfer pricing is on its own league. That is under performance measurement. Transfer pricing is the price that a division charges another division for selling to that division within an organization. That is transfer pricing. But pricing decisions have to do with how much price an entity charges for its products generally. So when it comes to pricing decisions, there are various reasons why. I think we discussed that during our last session on Saturday. There are reasons why, or there are factors that determines the price of a product. When we spoke about some of the pricing methods that organizations can use, the cost plus pricing. Under the cost plus pricing, we have the full cost plus pricing, and then we have the marginal cost plus pricing. We have the penetrating pricing. We have the scheming pricing. We have the prestigious pricing. We have the product or complementary pricing. So transfer pricing is what a division charges another division for selling to them within the same organization. But pricing decision is one of the short-term decisions that guides organizations, the price that they charge for their products generally to the public. So unlike transfer pricing, which is internal, how do we call it? Pricing decision, it's external generally. Pricing decision is external generally. Let's see. All right, so you're welcome. Right, so like I said, if there are any questions, you can put it in the chat and I will answer them for you, or you can indicate by raising your hand and then I'll share my thought on that in that case. Say, I struggle with mixed variances. Is there a simple method you know of answering variances of multiple products? If you say variances of multiple products, you've not said anything really. You need to contextualize your statement, then I can share my thought real quick on that. Because if you say multiple products, are you saying the company is selling multiple products? Because if the company is selling multiple products, then we're going to have the sales quantity variance, and then we're going to have the sales volume variance in that situation. But if the entity is using multiple raw material, that is where the mix and yield variance is going to come in that case. So I don't know what exactly you mean. If the company, if you say multiple products, then you are referring to sales quantity and then the sales volume variance in that case. Perpetual Andy said, what? Good evening, sir. Can you please touch on transfer pricing? Transfer pricing in that situation. And then I'm also getting a comment here on what? Can you help me with yield variance? Okay, so the concept of transfer pricing, like I mentioned a moment ago, it's about how an entity charges, or how much a division charges another division for a service or for an undertaking in that particular situation. So let's say we have divisions within the organization. So this is the organization. I mean, we have the head office here in that situation, and then we have maybe whatever, maybe you have division A, and then we have division B. So let's say that division A is the division that is producing the inputs that is required by division B. So what's going to happen is that division A has to sell to division B at the end of the day in that particular situation. But then division A also has an alternative to sell to external people in that situation. So the question then is, what price should the division A charge division B when they are selling their raw materials or their outputs to them, because they are producing something that division B needs in order for them to finish their products and they can sell to the outside. So the price at which division A sells its product to division B is what we refer to as the transfer price. Now, at the end of the day, what happens is that the objective of transfer pricing is to enable the organization to achieve goal congruence. Now, goal congruence simply means that each division is going to be autonomous. They are on their own. They are responsible for everything. However, they must make sure that they are achieving their objectives and also achieving the corporate objective. What does that mean? So goal congruence simply means that the selling division has to sell at a profit, the buying division has to buy at a least cost, and the company as a whole must make a profit. That is the concept about transfer pricing. But the big question we then ask ourselves is, at what price can an organization or the selling division charge the other division for the product or for the service that is that they are rendering to them? And there are various methods that we can use to determine the transfer price. And the first one is the traditional cost plus pricing in that case. So this is where we say that the transfer price is simply going to be equal to the marginal cost of producing the product, the marginal cost of production, plus a profit markup in that situation. So that is the idea about the issue in relation to cost plus transfer pricing. So in other words, the division selling, if they want to determine their transfer price, all they do is, okay, how much cost do we incur? How much profit do we want to make? Then they will be able to determine the transfer price in that particular situation. But then there is a second way that the transfer price could be determined if we are taking into consideration the capacity of the organization, taking into consideration the capacity or resources availability of the division, availability, as well as external demand conditions. So that is the second scenario. Now, in the second scenario, what exactly is going on here is that we are actually going to find out two scenarios. So number one, the organization has the division has a limited capacity or limited resources. However, it has unlimited external demand. It has unlimited external demand. So in this situation, so it means that when you are dealing with transfer pricing, you got to learn, you should be able to read from the print what exactly is the condition of the selling division. Do they have limited resources or not? If they don't have any limited resources and they don't have any external demand condition, then chances are your cost plus pricing method is going to be coming on board. However, where the entity is going to be having some limited resources issues and they have some external demands coming in, then you got to be careful about how you actually compute the transfer price in that particular situation. So capacity is limited, but external demand is unlimited. Now, what do we mean by that? So let's say that in this scenario, what we're saying here is that maybe the selling division produces, let's say, 40,000 units of the products that it's producing in that situation. But of these 40,000, external people are maybe demanding for maybe 30,000 of that. And then the internal division that they need to sell to, they also need maybe 20,000 of that. So if you look at the scenario going up here, you realize that the two demands for the internal and the external is how much? 50,000 units. If you look at this, you realize that the 50,000 units, it's more than what the division can produce. What does that mean? One thing you must understand is that when it comes to transfer pricing, it will be the corporate policy that the selling division must sell to the internal division first before satisfying external demands. And that is very, very critical that you must understand. It will be the head office policy to satisfy internal sales before going for the external sales. So if you look at it, should they produce the 40,000 and sell 20,000 to the internal division, it means they cannot satisfy all the 30,000 of the external division. So in this case, something has to go ahead in that particular situation. So what it means is that if the division want to sell 20,000 to the internal department, then they can only sell 20,000 to the external. For that reason, they are not able to meet all the external demand. When that happens, it means there has to be some opportunity cost issue coming up in that particular situation. So the minimum transfer price in this particular situation, now the reason why we are using the word minimum transfer price, it's because that will be the starting point for them to determine the price at which we should charge a particular product in that situation. So the minimum transfer price will be, okay, what much cost will we incur to produce the thing? So marginal cost of production plus the opportunity cost. The opportunity cost. Now, when we say opportunity cost here, we mean the lost revenue or probably the lost contribution as a result of not selling to the external people. So if we decide not to sell to the external people, what are we losing? What we are losing, the profit we would have made from the sale, had we sold everything to the external people, become an opportunity cost that we would have to take into consideration in that situation. So that is the first scenario. The division has limited capacity or limited resources, but then unlimited external demand in that case. Second scenario, probably they have unlimited capacity. So meaning that we are not having any problem. So unlimited capacity or resources. But then guess what? External demands are limited. But external demands are limited. So in that situation, what is going to happen is that, for instance, the selling division is producing probably 25,000 But guess what? The external demand is probably just 5,000. And then the internal people are demanding maybe just 10,000. So you realize that when we put the two together, we are getting just 15,000. That is far below their production capacity. So here, there will not be any opportunity cost issue. So under this particular scenario, the minimum transfer price would just be the marginal cost of producing the products in that situation. The marginal cost of producing the products. That's all. I wanted to write something again, but that would just be the marginal cost of producing the products in that situation. So that is the issue about that. That is the issue about that. So if we are dealing with the issue about transfer pricing, that's what you do. Now, the discussion we've had so far is from the perspective of the entity selling. But then the entity buying may also have a choice to procure the goods from an outsider in that particular case. So maybe the buying division may have a choice of procuring the goods either from the internal division or probably an external supplier. So when they are making the decision about how much they can pay the internal division, they will take into consideration how much the supplier is offering. Meaning that if a supplier from external is offering $10 per unit, that means at most they can pay $10 for the transfer price. Meaning that if the internal division is charging anything like $11, they won't buy from them because it's cheaper to buy outside than to buy from the internal division. So in that case, there will not be any internal transfer. Because remember, the goal is to achieve goal congruence. The selling division must sell at a profit. The buy division must buy at a least cost, and the company as a whole should make a profit. So if we can procure the resources you are producing in-house at $10, and you are producing in-house and you're charging us $11, that's insane. So you can sell it to your outsiders and make your profit. We too will buy it from the outsiders so that we also make our profit. Then the group as a whole or the company as a whole makes a profit in that situation. That is why we use the word minimum transfer price here, so that if there is that external supply issue coming in, then we can find out how we can achieve a common grounds in that particular situation. So that is how you deal with the issue about transfer pricing. Any other questions? I see some of you joining us on Facebook as well as on YouTube. You are welcome. It's management accounting tomorrow. So you put in the chat box any questions you have for me to share my thought on, as well as on YouTube. Remember to give us a thumbs up on the video. It helps us a lot. The video will get more engagement and we can reach a lot of students. We have over 500 videos already on the channel, and we want to make sure we reach a lot of students across the country and assist a lot of students preparing for their exams, especially in this season. So for those of you who are with me on Zoom, if you have any questions, you raise your hand, we bring you up, or you can put it in the chat, and I will be able to answer for you as well. So for those of you who are with me on Zoom, you can put your questions in the chat or raise your hand and I'll call you up to deal with it in that situation. Sir, please, can you help me on yield variance? Okay, so what is the issue about yield variance? The concept about yield variance, like I said a moment ago, it's when the organization uses more than one material, then the yield variance would have to come to play. And the yield variance come in if we are looking at the outputs that a company is producing for that case. And we can calculate the yield variance in total and also the yield variance for each of the units in that case. So maybe if you are looking at the yield variance, if you are looking at the yield variance, what's going to happen in that situation is that you can look at the issue in relation to the fact that it's in total. So you just bring in the total material used for the period, You divide that by the standard material per unit. And then that will give you the units that we should have had. That will give you the units expected, or if you want the expected units. Then you compare that with the actual units that was produced. Compare that with the actual unit that was produced. So actual units produced. The difference of that could be favorable or adverse. So if your expectation is more than the actual, that is an adverse variance there. If your actual is more than the expectation, that is a favorable variance in that situation. Then you multiply that by the standard material cost per unit. You multiply that by the standard material cost per unit. So that is the idea about that. Now, when we say you multiply that by the standard material cost per unit, this is what we're talking about. Let's say that we're producing a product that has the following materials. Let's say material A, material B, let's say 2.5 kilograms, let's say at $5. 2.5 by 5, that would be 12.5, I guess. Yep. 12.5 here. Then material B, let's say 4.5 kilograms at whatever, $2, that would be 9. Then you could have direct labor, but I'm not interested in labor. I'm just focusing on the material here. So let's say that that is the standard cost card. Standard cost card, SCC, not SCC on the Kaswa road, but SCC standard cost card. Then you pull up the actual issue coming up here in that situation. Let's say that the company produced, so actual units produced, let's say they produce whatever, let's say 1,000 units, just on illustration purposes. Let's say that material they use, it's as follows. Let's say A, B. Let's say for the A, whatever, they used 3,000. I want to make sure that our figure doesn't become too outrageous in that situation. So let's say they use 4,000 kilograms here, and they use 3,000 kilograms here in that case. So that is the actual situation going on there. So how do you go about that in that case if you're calculating the yield variance? So what you do is that you could calculate, add this up in total, and that's 7,000 kilograms. So what we're saying here is that that 7,000 kilogram that we just had, that 7,000 kilogram, which is the actual issue coming up in that situation, we will ask ourselves that 7,000 kilograms should have yield. So 7,000 kilograms should have yield. So you divide that by the standard per unit. If you look at the standard cost card, material A is 2.5, material B is 4.5. So you add that up, and that's going to be 7 kilograms. Are you following the idea? 7 kilograms. So if it is 7 kilograms, so over 7 kilograms here, and I think that should be 1,000. Wow, it's like no variance here. I love the question, the way it is. So 7,000 divided by 7, that's 1,000 units. So should have yield 1,000 units, but did yield 1,000 units. I mean, for my illustration, I said the actual is 1,000 units. So realize that here there is no difference. Hence, there would be no variance in this particular situation. So that is the issue about that. But assuming there is a difference, I mean, because that is, so it means you can do this and you are not getting any variance. That doesn't mean you are wrong or whatever it is. But let me pull up another scenario, because I know you are not looking for something like this in your question that you asked. Let's say that they got 1,200 units. So let's say the actual is 1,002. So in that case, I would say that 7,000 kilograms should have yield we divide that by 7, and that's 1,000 units, right? But did yield, how much we got? 1,200 units. So you realize that here, not 12,000, 1,200. So you realize that here we're getting 200 units, and that is favorable. I mean, we are getting more units than we're supposed to have, but remember that is in units. So what you do is that you bring in the standard material cost per unit. The standard material cost per unit in that situation. Now, how do you get a standard material cost per unit? You just go back to your standard cost card. Material A, the cost per unit is $12, 12.5. Material B, the cost per unit is 9. So you add that up, and that's going to give you what? 21.5, I guess. 12.5 plus 9. Yup. $21.5, something like that. So you're going to multiply this by 21.5. And that gives you the variance in that case. So you're going to have something like 200 by 21.5. And that's $4,300 favorable. So if you ask me about the yield variance, that's how you calculate the yield variance. Now, this is the yield variance in total. Okay, that's the yield variance in total. But what if we are doing for per unit basis? I mean, how do you go about it on per unit basis? For me, because I want to do the yield variance, let me do the mixed variance as well in that case, because I got a question on that on YouTube as well. So the mixed variance, the idea simply is that it is standard quantity in actual mix minus actual quantity in actual mix, okay, multiply by the standard price. Okay, multiply by the standard price. So you want to be careful here about exactly what's going on. Standard quantity in actual mix, actual quantity in actual mix. That is if you want to do the mix variance. If you want to do the yield variance, we're going to go through the issue in relation to standard quantity in standard mix minus standard quantity in actual mix multiplied by the standard price in that particular situation. So you want to make sure you know exactly what you are looking out for in that case. So if I'm doing the mixed variance in this particular situation, how am I going to do that? So let's look at it. So the mixed variance. So the mixed variance, let's see what we got. So standard quantity in actual mix, actual quantity in actual mix. We're going to have the difference here. Then we're going to have the standard price here. Then we're going to have the variance. I'm going to squeeze some things up here a little bit, but let me see. Let me rather make it a little bit. Standard quantity in actual mix. Almost always I struggle with making this thing going on my slide. Actual mix. We're going to have the difference coming up. We're going to have standard price. I'm going to screw up again. But I guess we got it. Something like this. So if this is what we have, I mean, how do we go about it in that case? So standard quantity in actual mix, actual quantity in actual mix. Now, so what do you want to do all the time? Okay, what do you want to do all the time is not to freak out. So what do you do? So we're going to bring the materials up. So we have material A coming up. We have material B coming up. Then you're going to pretend to close it, What you want to do is get a trick, very simple. What you want to do is that you want to pick the actuals and bring them up. So in my illustration, my actuals are 4,000 and 3,000 respectively. So that is the actual quantity in actual mix. Okay, 4,000 and 3,000. That gives us 7,000 in that particular situation. So 4,000, 3,000. Now, The total is 7,000. So you put that 7,000 under standard quantity in actual mix. Like you put that 7,000. Now you're going to apportion that 7,000 between material A and material B using the standard usage mix. Using the standard usage mix. Now, if you look at the question, what is our standard usage mix? It is 2.5 for A, 4.5 for B, and that together gave us 7,000 kilograms. That together give us 7 kilograms, 7 kilograms. So if we are doing ratio and proportion, I mean, you did this in kg2, that's going to be 2.5 over 7, and this is 4.5 over 7. Okay, all will multiply the 7,000 respectively so that you do chimpe on that one. 2.5 over 7 times 7K. I'm getting 2,500. Then 4.5 over 7. I'm getting 4,500. Okay, so what is the standard quantity in actual mix? The standard quantity in actual mix simply about of the actual quantity that we have used, based on our usage ratio, this is what we should have used, and this is what we used in that particular situation. So if you look at what is going on in the material A, based on the usage ratio, we should have used 2,500, but we used 4,000. So the difference is going to be 1,500. And that's going to be an adverse variance there in that case, because I mean, we've used more than we should have used as per our ratio and proportion. But the material B, we're using less than that. So that's going to be some favorable variance, also 1,005 in that particular situation. That's going to be favorable variance in that particular situation. Then we bring in their standard prices respectively for my illustration. It is $5 and $2. So 5 here, 2 here. Let's pull it up. Let's see what we got. 1,005 by 5, 7,500. Remember, that is favorable, and this, sorry, that is adverse, and this is 3,000 favorable in that situation. So minus 7,500 plus 3,000, that's going to be 4,500 adverse. So that becomes the variance in that case. So that's how you deal with a mixed variance, okay? Standard quantity in actual mix simply means, okay, based on our budget, what exactly is going on there? How much should we have used? But if you look at what you used, what exactly is going on there? So that is the idea there. Then if I'm doing the yield variance for each of the products in this situation, the yield variance, like I told you, it's going to be standard quantity in standard mix, then the standard quantity in actual mix. Now, if you watch that carefully, you realize that from the mix variance, you've done the standard quantity in actual mix already in the yield formula. Do you get the idea? You've done that already. So you just pull up those same figures coming up so that you can all get a standard quantity in standard mix in that particular situation. I guess I'm going to be squeezing it here. So let me go on the next slide. So the yield variance for each product, let's see what we got. Again, our presentation is going to be freaking me out here. Standard quantity in standard mix, standard quantity in actual mix. We're going to have the difference coming up. We're going to have the standard price coming up. We're going to have the variances also coming up in that situation. We have our materials respectively. So material A and material B. Now, since you have standard quantity in actual mix, from the mix variance, you pull it up real quick, like what I told you here. This one, this one, this one, this one, this one. You have it already. So you're going to pull it up, 2.5 and then 4.5. So 2,500, 4,500. And that adds up to maybe something like, is it 7,000, I guess? Now, stay with me carefully here. The standard quantity in standard mix, it's simply going to be how many units we should have used based on the actual, how many material that we should have used based on the actual unit we produced. That's the standard quantity in standard mix. So if you look at the actual units that we have produced, like how many quantity of materials that we are supposed to use, that is what the standard quantity in standard mix is about. So if you go back to our illustration, I mean, we produced, which one are we using? I guess we are using the 1002, I guess. Yeah, we are using the 1002. So if we produce 1002 units, how many kilograms of material A should we have used? How many kilograms of material B should we have used? That is the standard quantity in standard mix. That's the idea going up there in that case. So 1,200 is the benchmark. Is the units we produce. We're going to multiply that by, what are the usage? 2.5 and 4 respectively. 2.5, 4.5. I'm supposed to do that on the schedule, but my space is limited. So 1,002 by 2.5, getting 3,000. And then 1,002 by 4.5, getting 5,400. So stay with me carefully here so that you can understand exactly what is going on here. So we should have used 3,000 kilograms for material A, but based on the ratio and proportion of the actual material used in the standard, we used just 2,500. That's a good deal for us. That's a good deal for us. So that's 1,500 there, and that's favorable in that particular situation. If you look at material B also, we should have used 5,400. But if you look at the ratio of the actual quantity used as per what we used, it's 4,500. So it means that, I mean, we again used less than we are supposed to use. So let's say 5,400 minus 4,500. That's going to be, I think I get 900. That's also going to be favorable there. You multiply that by the standard prices respectively, 5 and 2. 5 and 2. So 1,500 by 5. That's 7,500. 900 by 2. That's 1,800. You add that up, and it gives you the variance in that situation. And that's, what do we have? Let's see. 1,500 by 5, 75. 900 by 2, 1,008 plus 7,500, 9,300. What did we have in the total when we were doing? We got 4,300. Whoa. Then there's some mess up somewhere. Let's cross check to see what could be the issue. Let's see. I used the 1,002 here, right? Against the actual unit of 7,000. And that yielded us 4,300. So what could be the, let's see. Oh, this is just 500. I made a mistake. This is just 500, not 1,005. It's just 500. Because 3,000 minus 2,500 is just 1,005. It's just 500. So 500 by 5, that should be 2,500. So 2,500 plus 1,800. Yeah, 4,300. Okay? When you are wrong, you should be able to know you are wrong in that situation. So you see that when I do it for the individual products, I'm getting 4,300. If I do it for the total, I'm getting 4,300. That is how you deal with the yield variance. It should be equal. Whether you do for individual or you do for each of the products, it should be equal at the end of the day. And So when I realize that my answer is different, I need to really go back and find out what the heck is going on here. And I realized that arithmetically I've been wrong somewhere. So that is the idea about mix and yield variance. I mean, doing it in total and doing it for each of the products in that particular situation. So that is the idea about that. That is the idea about that. So if you ask about mix and yield variance, and then Blessing on YouTube also, you asked that you had a problem with calculating this. I hope that your issue has been dealt with as well. And then who also asked this on the chat? That's Solomon, I guess. So that is the issue about mix and yield variance. Like you see, it's very simple, okay? It's very simple. You just have to understand the concept that is going on here and know the formula that we are doing, like the way it's happening and how you know it's favorable or adverse. Just know the concept behind it, and Charlie, you'll be good in that case. You'll be good in that case. Okay, so Blessing said, yes, it was very well helpful. Said, thank you. You are welcome, Blessing. That's great. I see some of you guys joining on YouTube. You are welcome. This management accounting, comment in the chat box, any questions you have for me. And on Facebook also, I see some of you watching. Welcome. Stella Okoli said, good evening, sir. Good evening, Stella. You are welcome. Yeah, you're right. Mazikanda. Forgive me if I don't mention your name right, okay? Mazikanda. I think I love that one. Mazikanda. Hi, I'm a newcomer. Greetings from Harare. Oh, shout outs to you in Harare. Thank you for joining us. Charles Basso said, good evening, sir. Good evening, Charles. I hope you're doing well. Stella Okoli said, thank you, sir. You're welcome. Adam Osman said, good evening, sir. Good evening, Adam. You're welcome to the stream. Okay, so any questions, please put it in the comment section on Facebook, in the chat section on what I'm saying WhatsApp, on YouTube. Then for those of you who are joining on Zoom, you can raise your hand and I'll bring you up, or better still, put it in the chat and I'll read your questions for you in that situation. Okay, so I'm seeing something on this. It said what? Please, what are some of the management concepts that management accountants can use to achieve customer satisfaction? If you say, what are some of the management concepts management accountants can use to achieve customer satisfaction? Number one, it's about cost control and cost reduction. Because if we find ways and means to control our costs and incur a minimum cost as much as possible continuously, that means that all other things being equal, our product will be affordable, and we can satisfy our customers and also provide them after sales services. If we look at cost reduction, which is now cost control is a continuous thing, but cost reduction is once in a while where the entity identify an opportunity that it can reduce the cost per unit of a product. So unlike cost control, which is a continuous thing that the organization does every day, every year, finding out how we incurring the cost within the cost that we are supposed to incur, cost reduction is only done and it relates to the reduction in the unit cost of the product. And that one, the entity only does it when it identifies an opportunity that they can take advantage of. So if we want to do customer satisfaction, one of the concepts will be cost reduction, cost control. Another thing is about TQM, that is total quality management. Because if we have, like you know already, total quality management has to do with a continuous improvement in production efficiency and having zero defects in our production system so as to enable us to achieve our objective as an organization and also satisfy customers. So one of the concepts that we can also use is in relation to total quality management. So the concept about cost reduction, the concept about cost control, the concept of total quality management can be used as well to achieve customer satisfaction. Then there is one other concept that I could bring up, but it's not coming off head. Probably later on I could look at that in that case and then share some thoughts with you on that. But that's what I'm up with right now in relation to that. On Facebook.
Hello, Nhyira.
Yes, hello.
Hello, Nhyira. Can you touch on capacity ratio, efficiency ratio? I think I saw it in the syllabus under variance analysis.
Actually, the issue about capacity ratios is one of the labor ratios that you need to look out for in that case. I'm going to share a slide on with you on that. On Facebook, Taylor Isaac said, "Good job, sir. We will be expecting same for PSA." All right, definitely we'll be coming your way the day before PSA in that case. Nana B said, "Good evening, sir." Good evening, Nana B. Please, what are some of the key areas we should expect under management accounting in parts? In parts, are you referring to part 1 or whatever? I think you spelled KEN. Sorry, KNE. I don't know. Maybe you wanted to write 1 and I think O is close to K, right? No, it's not that close to K. So I don't know. Maybe you're talking about man accounting in part 1. Maybe you can clarify that, then I can answer you better. So accounting for labor. Let me go to this is my book on management accounting for your information. It's very important to know the materials that I'm sharing here so we don't have any copyright issue coming up. So this is my management accounting book and I'm sharing something on that. So page 41, let me take you there. Let's see. Okay, I think I'm here. Yep. So the issue about efficiency ratio, capacity ratio, this is about labor assessing or measuring the labor efficiency and how labor, I don't know if this is what you are asking about, Dennis. I think you brought it up. Is this what you are asking about?
Yes, Nhyira.
Okay. So these ratios are, or measurement indicators are indicators that are used to assess efficiency of the labor force within the organization, and there are 3 of them. So production volume ratio or activity ratio, efficiency or productivity ratio, and then we have the capacity ratio in that particular situation. And the reason why you're seeing the red and the green and the blue colors in my slide is because I had discussed it with someone. So let me clean this up here so we can do from scratch. So I want to share this with you real quick. So, and I don't want to write that much. So let me just clean the previous things here. So we go. Now, so these ratios, like I said, are used for labor, and it's one way we can assess labor efficiency within an organization. And so efficiency ratio, what is the formula for that? That is the formula you see there. Capacity ratio, what is the formula for that? That is the formula you see there. Production volume or activity ratio, what is the formula? That is the formula you see there in that case. So it is expected hours, expected hours to make output divided by actual hours taken. So you want to assess efficiency of labor. You know that the traditional variances, how do you assess efficiency of labor? The efficiency of labor, direct labor efficiency variance, if you remember the concept well, we said it is based on what? The actual units produced during the period. So the actual units produced, how many hours should we have used? How many hours did we use? That is, we are doing the traditional variance. But there is another way you could determine labor efficiency, and that is to use this ratio, and that is the expected hours to make the output divided by the actual hours taken times 100. You get the idea here? So it's the same should have used, did use, but this time around, you're just working in percentages. In the traditional variances, you multiply it by the standard rate, so you get a variance in currency. In these ratios, you are not multiplying by the standard rate. You are multiplying by the 100 because you are getting your answers in percentages. That is the difference between that traditional one and this one, so that you don't get it messed up in that case. So expected hours to make the output, meaning that, okay, how many hours did we want to use for a product? How many units did we actually produce? Multiply it up. That is the expected hours taken. Then what was the actual hours the people used? What was the actual hours the people used? That is the efficiency variance. Then you come to the, that is the efficiency ratio, sorry. Then you come to the capacity ratio. Capacity ratio. Now, when it comes to the issue about the capacity ratio, it's about the actual hours worked compared with the actual hours we budgeted for. Now, capacity, this one is also one of the variances that you could calculate under variable overheads, where you are comparing your budgeted hours with your actual hours, or you are comparing your budgeted units with your actual units. So if you look at it, we budgeted a certain hours for the period. Did labor work for that hours or more than that hours? That is what we mean by the capacity ratio. We want to assess, is labor working to the capacity that we've set aside for the company, or working below the capacity? That is what the capacity ratio tries to assess. So what was the actual hours worked for, and what was the hours we budgeted for? So here, it is about budgeted hours. You are not taking into consideration the actual units produced. No. In the expected hours, you are taking into consideration the actual units produced. But in the budgeted hours, it is actually the original hours that we've budgeted for the actual unit, for the period under consideration. The actual units we budgeted for the period under consideration. Then production volume ratios. This has to do with the output in expected or standard hours divided by the budgeted hours in that case. So what was the hours we expected to, or that we use for the actual units we produce, as compared with the hours that we had budgeted for the period under consideration? That is the idea about the production volume ratio. So there is a guinea pig question here that I'm going to use to just illustrate to you what exactly is going on in these ratios in that case. So example, Russian Fluster Co. budgets to make 25,000 standard units of output in 4 hours. Did you get that? In 4 hours. So it means that the standard hours per unit is 4 hours per unit during a budgeted period of 100,000 hours. It makes sense, right? Because 25 by 4 is actually going to be 100,000. So it makes sense in that situation that the budgeted hours is 100,000. Actual output during the period is 27,000 units, and it took 120,000 hours. Calculate efficiency, capacity, and production volume ratios. Calculate efficiency, capacity, and production volume ratios. Actually, this is one of the simplest things that you can actually find out, or that examiner can ask you in the exam hall in that particular situation. So let's see how we go. Efficiency variance. Efficiency ratio. What did we say on efficiency ratios? We said that the efficiency ratio is the expected hours to make the units produce divided by the actual hours we took. So if you check on the standard level, let's pick a blue marker. We wanted to use 4 hours. How many units did we produce? 27,000. So the expected hours to make the actual units is going to be 27,000 times 4. Okay, 27,000 times 4. And that is going to be 108,000. But then they actually used 120,000. And that's 90%, as you can see here. It means the efficiency level is what? 90% in that case. Because per the standard, they should have used 108, and they are using 120,000. So they are using more hours than expected. So if we're doing the traditional variances, this would have been an adverse variance. And since their efficiency level is less than 100, it means they are not being efficient. What it means here is that probably there are some idle time issue coming up here in that situation. We don't know though, but it could be because of idle time, or it could be because of labor. They are new, so they are now learning. That's why they are requiring more hours in that case. Or maybe there was some machine breakdown or inefficiencies in the production system. That is why the efficiency, it's not over 100 in that particular situation. So that is the idea about the efficiency ratio. That is the idea about the efficiency ratio.
Nhyira,
Yes.
please, so the 100,000 units, the 100,000 hours. I think the 100,000 hours is the same as is it the expected hours?
No. Expected hours to make output. Get a concept. To make output. To make the actual output produce. To make the, so it's not that the 100,000 hours is the budgeted hours. But the efficiency ratio, that expected hours there, is the expected hours to make the actual unit we've produced. So that's the difference there. That's the difference there. Expected hours to make output, not to make budgeted output, but to make the actual output produced. So for the 27,000 units, how many hours should we have used? That is the idea here for the expected hours. That is the idea for the expected hours. Then it comes to the capacity ratio. And we said that that's going to be the actual hours worked divided by the budgeted hours. So if you look at what is going on here, actual hours is 120,000. You can see that directly in the question. But the company budgeted for 100,000 hours. So what does that mean? It means that labor is operating above what? The capacity that we had expected. Probably it could be because the budgeted unit is different from actual unit. So if budgeted unit is different from actual units, they may be operating over the capacity that we had budgeted for in that situation. Or again, there could be some machine breakdown, inefficiencies. That's why they are using more hours than used. But in a nutshell, when it comes to the capacity, if it is above like this, they are using more hours than we budgeted for. That means all other things being equal, they are producing more than we had budgeted for, which means that they can actually work more hours than we thought they would have worked, because the budgeted hours is what we expected them to work. But at the end of the day, they worked more. It could be good or it could be bad based on further information provided for us in the question. Then the last one is production volume ratio. And that is also going to be your output measured in expected hours over there.
Nhyira,
Yes.
please, the hours here, is it machine hours or labor hours?
It's labor you are dealing with, so it's labor hours. It's labor hours.
Okay. So does that mean they use maybe unskilled labor? That's why they are using more hours. So
It doesn't mean they use unskilled labor, but it means that labor is operating beyond the hours budgeted for, the capacity budgeted for the period under consideration. So it does not mean there are various reasons why this could be, but further information is not available, so there is no decision to be made here. But just on the face value, what can be said is, yes, labor is operating beyond the capacity set, So we can say that labor is doing well in that situation. But then from the efficiency variance, which is below 100, where they are actually using more hours than they are supposed to have used, then it tells you that probably the reason why the capacity variance is also above 120 or above 100 is because labor is inefficient, or there are material or machine breakdown, and there are a lot of idle time coming in there. That's why they are having that ratio. Then the last thing is the production volume ratio in that case. And the production volume ratio, that is going to be the issue about your output measured in expected or standard hours as against the budgeted hours. So if you check how many hours should we have used and how many hours did we actually budgeted for. So if you look at it, we budgeted for 100,000 hours, but based on the units that they produced, they are supposed to, they've used 108,000 hours. So here it is 108% in that situation. So it means that we actually expect them to have more production units coming out than we had budgeted for originally in that situation. So when you talk about the issue about these ratios, that is what you need to understand there in that case. I see some of you guys joining. If you have any questions, you put it in the chat on Facebook, in the comment section on Facebook, and then in the chat on YouTube. For those of you on Zoom, you can indicate by raising your hand, then I could bring you up, or you can put your question in the chat, then I could provide you with some answers in that case. Adams Osman on Facebook said, what are the areas we should expect in management accounting tomorrow? Oh, areas to expect, whatever is in the syllabus will be examined. So each topic in the syllabus is examinable. So that is what I would say there. There will be question on budgeting, it's waiting for you. There will be question on variance analysis, is waiting for you. There will be question on performance measurements. Question 1 is actually glancing or glaring at you, literally in that case. There will be question on short-term decisions. Question 5 waiting for you in that case. If the examiner is excited, investment appraisal, there will be question there for you. Then there will be also a ghost question in the exam, or something that, you have no clue about. Or you may not have read about it, or probably you were reading about it, but you were not excited about it, so you left it. And that could also be asked by the examiner in that particular situation, and that's going to be there. So every segment of your syllabus, there is going to be something coming in that the examiner is going to be examining on, and I will not mention anything here, but every segment is going to be having something there. So what you want to do is to make sure that you cover as much as you can, but most importantly, like I say all the time, you make sure that you answer the easy questions as fast as possible. The theory questions in the scenario, you could pick it up in that situation, and you know what exactly to do in that case. So the theory areas in the question, you want to make sure that you bring that up, or you answer that as quickly as possible, and then you will be able to save some time and spend on some other issues. But one thing you must understand here is this: management accounting, 99.9% of the time, the question is going to be a bit voluminous. So the volume of the question is going to be a bit bunched in that particular situation. But that doesn't mean you will say that, I don't have time to read all the question. I'm just going to read. You read just the part you like, then you start answering. No, you got to make sure you read all. And there is going to be a temptation on you for you not to read the whole questions, but you want to make sure that you avoid that temptation, especially when you're dealing with a question 1 especially when you're dealing with budgeting, especially when you're dealing with variances, there will be something somewhere that you may not take note of. And what you want to make sure you do is you read the questions everywhere. Don't leave anything there. Make sure you read everything that has to be read before starting to answer the question, because that is going to assist you well for you to actually pass the exams in that case. So that is the idea about that. Then I'm seeing a comment coming in. Let's see. What do I have? Say, what are the steps to implement zero-based budgeting? Steps in implementing zero-based budgeting. Traditionally, you would have to look out for how zero-based budgeting actually work at the end of the day. It's a budgeting system where you are actually starting everything from scratch in that particular situation. So you don't consider the previous period to as the basis, or you don't consider the previous year budget as a basis in the preparation of the current year budget. So what you are doing is that you are going to justify every item before it will be included in the budget. So what happens in zero-based budgeting is that there are certain steps that we go through. You need to determine the decision packages. You need to look at the resources that you have available. You need to rank the decision packages, then you can allocate the resources. Let me see if I can get that from my slide here on budgeting in that situation. Which page do I have budgeting? That is page 212, 224, 236, 248. Okay, so this is budgeting. Let me go to the methods straight up, and then, yeah, this is it. This is what I was sharing with you a moment ago. Implementing zero-based budgets. Like what steps do you go through in implementing zero-based budgeting in that case? So you can take a screenshot if you're excited about that or something like that. But let me go through that. So there are three steps. There are three-step approach to zero-based budgeting. These are, you define decision units, what decisions you want to make, you evaluate, and then you rank packages, then you allocate the resources. So number one, you identify all decision packages. So what are the decisions we want to make for the period under consideration? What are the activities we want to undertake? Then we'll prepare the budget for those various decision packages. When we finish, we evaluate and rank each decision package in order of preference for the organization, because this is where scale of preference comes in. Yes, it is important for us to buy that new machine. Yes, it is important for us to employ some staff. Yes, it is important to increase wages and salaries. Yes, it is important to buy that delivery van. But do we really have the resources available for the delivery van? Do we actually have the resources available for the issue in that case? So we need to find out exactly what is going on in that situation. So we rank, we evaluate, then we rank. Then after that, we then allocate the resources or the funding to the various departments or various decision packages that has been made by the organization in that case. So that is the issue about dealing with this aspect of that. So that is the issue about that. So if you ask the implementing of zero-based budgeting, that is what you need to understand. I see some of you joining. If you have any questions, you raise your hand. For those of you who are with me on Zoom, you raise your hand, I'll bring you up. And then if you're on YouTube, you put it in the chat box. You're on Facebook, you put it in the comment section. I'm going to read all your comments and try to answer them in that situation. Let's see on Facebook if we have some questions coming up. Okay. Give me a moment. Let me bring this up real quick. Okay. Let's see. Okay, no question on Facebook coming up. Okay, you are welcome, Isaac. Okay, let's go on YouTube. Let me see what exactly we got there. Blessing said, say, in stock control, economic order quantity, determining demand is sometimes confusing. Can you please explain different ways to determine the economic order quantity in the questions you can come through? Economic order quantity, when you say different ways to determine EQ demand in a question you have come through, I need to contextualize that, but I can't get the idea exactly that you are, because if it's about calculating the economic order quantity, I mean, that is going to be just the issue in relation to what is going on within the organization, and that is going to be our annual demand, taking into consideration the annual demand, taking into consideration what's the formula for that? I think
the formula is 2.
Yeah.
2 then raised to the it's not raised to the power.
It's square root of 2D.
Yes, 2DCO over CH.
HCO. So that is economic order quantity. This is for accounting or management of inventory. So I don't understand the context of your question, so I can provide a better answer in that particular situation. In that case, so maybe you contextualize your question, and I will be able to deal with that for you. On Zoom, I'm seeing a question coming up. Bottom-up budgeting. I mean, that is part of behavioral aspect of budgeting, but bottom-up budgeting is where budget is imposed by, let me see your comment again. Okay, bottom-up budgeting. Okay, so this is where it is like participating budgeting. So this is where, unlike top-down budgeting, where the budget is prepared by the head and imposed on the departmental heads, bottom-up budgeting, it's where budget holders participate in the setting of their own budget. So the bottom-up budgeting is more or less like participating budgeting, where the heads of the various divisions, set their own budgets and they bring it up for management to consider. And it's the direct opposite of the top-down budgeting, where senior managers prepare the budget and then they dump it on you and you don't have any excuse. All you have to do is to make sure that you implement it in that situation. So that is the idea about bottom-up budgeting in that case. That is a behavioral aspect of budgeting in relation to that. On YouTube, can you please take us through the budgeting, the functional and the master budget? That is a broad thing. Maybe if you can be specific, then I can know exactly what to talk about. But if you say the functional and the master budget, that is a broad thing that I will have to go through. So if you ask me something specific, then I could provide you with some answers in that case, because Functional budgets, they are budgets that are prepared by the various departments within the organization. The master budget is the putting together of all the functional budgets, which is made up of the cash budget, the budgeted income statement, and the budgeted statement of financial position. So if you're looking at the functional budget, you are looking at the sales budget, you are looking at the production budget, you are looking at the material usage budget, you are looking at the material purchases budget, and that will be both in value as well as in kilograms or in quantity. Then you're going to look at the labor budget, and that is also in hours as well as in value in that situation. And then you put all that together. There's an overhead budget that you will be preparing based on the question. Then you prepare your cash budget, in that case. So if there's something specific, then you could bring it up, but that is a broad question for me, and I wouldn't know where to start and where to actually end, because budgeting is a whole topic on its own that we need to talk about. But I guess there are some videos on our channel on budgeting. I don't know though, but now we have a lot of videos on the channel, and I cannot really talk about what we have or what we don't have. So you can check the how do we call it? You can check the channel on management accounting, the playlist on management accounting, and you can get some answers to that question there. Then there is another question coming in on YouTube. Let me look at that as well. Okay, let's see what we have here. Facebook, I see some of you guys coming up. You put in the comment section any questions you have for me. So Henry Tete Barriga said, Nhyira, the reading topics, which areas should we look at? That'll be a hard question for me to answer in that particular situation, because management accounting, there are a lot of things. Every topic has its reading. There is a reading area under investment appraisal. There's a reading segment under budgeting. There's a reading segment under variances. There's a reading segment under performance evaluation. There's a reading segment under everywhere. Short-term decisions. There's a reading. So every topic has a reading area in that case. So you want to approach it holistically. If you are doing short-term decisions, what are the reading areas? If you are doing investment appraisals, then the advantages, disadvantages of the methods. If you are doing variances, the types of variance, the types of standards, the advantages, the disadvantages, the stages involved in standard costing. So each topic has a theory there in that case. And then apart from each topic having a theory, there are some exclusive reading topics like value chain analysis, total quality management, environmental accounting, the balance scorecard. I mean, that was the last semester. I mean, for you to write on the 4 perspective. This semester, the examiner may not be excited about it to repeat that again. If anything, it will be in question 1, where you are going to be preparing the balance scorecard or using the balance scorecard to assess an organization's performance. So value chain, total quality management, and all those issue there. So actually every topic has a theory area in that situation, and I wouldn't say pick and choose the theories. I would say every topic you are approaching, approach it holistically. In as much as you are not seeing the computations that you're going to be making, you have to also be able to look at the issue in relation to the theories that are surrounded in that area in that case. So that's what I would say in that case. I wouldn't say look at specific areas, but always there is going to be a theory question in the exam hall for management accounting, and 99% of the candidates might have not seen it before, or might have not read it, might have not heard it from anywhere, and that's going to be between 2 to 5 marks in that situation. And I mean, you should be ready for that in that case. But aside that, every topic has a theory that you need to look out for in that case. So that is what I would say, Henry, for you. I mean, there is no area you have to focus on. Every area is examinable in that case. Then I'm seeing another comment coming in as well about benchmarking and what re-engineering processes in that case. The idea about benchmarking is the process of comparing business process performance and performance metrics to the industry best practice from another company in that case. That is the idea about benchmarking. It's a practice of comparing business processes, performance metrics to industry best practices or best practices within the organization of other companies. That is the idea about benchmarking. So you are like, okay, we as a company, we have some key performance indicators. Okay, who determines whether your key performance indicators are good or not? They have to be benchmarked against, probably if you're a manufacturing company, then the quality standards for maybe, I don't know, Food and Drug Authority, the Ghana Standard Authority, some ISO certifications. So we have to be looking at, are we producing to that quality standard set by them? That is the idea about benchmarking in that particular situation. So are we producing to meet that standard? That's the idea about benchmarking. So you comparing your KPIs with an industry best practice, or comparing your KPIs or performance metrics against another company which you seek to be higher than you, that will be what we mean by benchmarking in that case. So that's the idea about benchmarking. Then the issue about business process re-engineering is the process of re-engineering, for instance, a business management strategy. So for instance, to re-engineer simply means to change the way you do your things. So probably we are implementing some strategy currently as an organization, and probably it's not working well, and we want to change the strategy. So it could be the designing of our products, that is re-engineering. It could be changing of our production systems, that is re-engineering. And the reason why a company would re-engineer is, number one, to increase customer satisfaction. Number two, to be able to achieve its corporate objectives. Number three is to be able to do that as part of rebranding processes. And then, so customer satisfaction, reduction in the production cost, or changing its production system. All these has to do with the issue about re-engineering in that case. So whilst benchmarking is about comparing your metrics against the industry best practice, then you're finding out, am I operating like what the best practice is saying or not? Re-engineering is more internal. You are finding out, what can we change? What can we do differently so that we will be able to achieve our objective as an organization? So that is the idea about the differences between the issue in relation. Okay, you didn't ask for the difference. You just asked for my thoughts on them. So that is the issue about business re-engineering, redesigning how you do things within the company, and then benchmarking, comparing your metrics, why am I saying metrics? Comparing your metrics, KPIs with industry best practice, or a company that is operating higher than you in that situation. So for instance, let's say we are a manufacturing company and we are manufacturing Sobolo, and benchmarking could be we trying to compare our production system with, say, Accra Brewery Limited, because I mean they are big, they will have better total quality control management system in place. So when we try to look at our performance, our systems, our mechanisms with them, what we are doing is benchmarking in that case. And the purpose of benchmarking It's to improve upon the quality of our products, and it is part of total quality management and ensuring that we produce quality products, satisfy customers, and we comply with the various laws that governs what we are doing as an organization. Then we come to another question coming up here. Please touch on make or buy with limited factor. Now, the idea about make or buy where the organization has a limited factor here, it's simply to, rank the product, and that's it in that situation. So what's going to happen here is you're going to look at your marginal cost of producing the product, and then you look at the cost savings per your limiting factor in that situation. So let's say we are producing two products, product A and B. We could pull up direct material coming in. Pull up direct labor costs. Like, you just bring in the marginal cost of production. Specific fixed cost is not considered here. When there is a limiting factor here, specific fixed cost is not considered. The reason why specific fixed cost is not considered when making a make or buy decision with a limiting factor is that, listen carefully, is that irrespective of the number of units of the product we produce, the specific fixed cost will be incurred anyway. Irrespective of the number of the units of the product we produce, the specific fixed cost will be incurred anyway. For that reason, when we are doing a make or buy decision with a limiting factor, all we do is, what is the marginal cost of producing the product, the variable cost of producing the product? Specific fixed cost will not be considered. So whatever it is, direct material, direct labor, if there are any variable overheads that we're going to be incurring, that is going to come up, and that gives you the marginal cost of production. In that case, then you find out as an organization what is the usage of the limiting factor. So you bring your limiting factor usage here, and that's going to divide. Then once it's divided, you're going to get I'm supposed to bring this. So this is the marginal cost of production. I made something. Let me retake it again. Then you bring the buy-in price. You know, sometimes when you're doing something and it is wrong, you should know in your brain that it is wrong. So you bring in the buy-in price. So you compare the marginal cost with the buy-in price. Now, usually, it depends on whatever is happening though, but if the marginal cost could be higher than the buy-in price, so that in that case, we'll get cost savings for manufacturing. Cost savings for manufacturing. Or for making, sorry. It could be for making or for manufacturing. So cost savings, then you bring in the limiting factor, resources that you have, usage per unit, you divide that, and that will give you the cost savings per limiting factor. The cost savings per limiting factor. So once you have the cost savings per the limiting factor, you're going to rank. So you find out the two products which is giving you higher savings per limiting factor if you make it in-house. Then you rank it. Whatever it is, 1 and 2. Then you use the resources to make the one that is saving you more first. If there is some left, you use it to make the other products. Then you can now find out how much of the product you have to bring from the outside in that case. So when you are dealing with limiting factor with, make or buy with limiting factor, what is going to happen is that you are going to be looking at the cost of making the products, excluding the, how do we call it? The specific fixed cost. And then you look at the buy-in price. Then you compare. What is the savings if we make it ourselves? What is the extra cost we will incur if we make it ourselves? You bring in your limiting factor, boom, then you should be able to find your answer in that case. So that is how you deal with the issue in relation to limiting factor or make or buy with a limiting factor concept. let's see. Okay, so
Nhyira,
yes.
so please, with this one, the product with the lowest cost saving, are you to pick the, I don't, when you are ranking lowest cost saving?
If you're talking about cost savings, as a management accountant, the product that saves you highest for making it in-house is what you have to produce in-house. So the one that gives you the highest cost savings for making is what you make in-house first, and then the other one will be outsourced, or the units of the other one will be outsourced in that case. So it is the higher, the better. But if you are dealing with extra costs, because this thing that I've written here as cost savings, it could also be extra cost of buying. If you flip it up to make it extra cost of buying, then in that case, the one that gives you the lowest extra cost for buying will become the one you have to make first. Then you think about outsourcing the other units of the other. So it depends on what exactly you are using in that case. If you are using cost savings, then the one with the highest cost savings per limiting factor is what you're going to make in-house. If you're looking at the external cost that you are incurring, then the one that gives you the lowest external cost for making it, for buying it, that is what you are going to be making in-house and outsource the rest in that case. Another question coming in. Let's see. Okay. Now, I see some of you joining on YouTube. You are welcome. If there are any questions, put it in the chat for me. I'm going to be wrapping up around here today in a few minutes. And I believe that we've been able to touch on some of the things that you wanted clarity on in that situation. So if there are any other questions, you can put it in the chat on YouTube, and then you can put it in the comment section on Facebook. And let's see what I can touch on, because I'm going to be wrapping up as we leave you to go and do your last miracles, and go ahead in that case. There is a question coming on saying, sir, can you speak briefly on preparing operating statements? I think when you say operating statement, you're referring to operating statement under variances. In that situation, let me see if I can pull up my slide on that from my management accounting class. So let's see. Let me see if I can pull up my slide on that and share that with you. Management accounting. The operating statement, we can use either, how do we call it? Marginal costing or absorption costing in that situation. I think I should have this somewhere here. That's under variances. Let's see section 10. Okay, this under budgeting. So 11, 12, 13. Give me a moment. Let me see if I can pull it up. Operating variances. Oh. Give me a moment. Let me see if I can pull it up because I don't want to start over. So it's in my, I did a shot on that, but because I'm sharing my screen, I wouldn't want to show other things in my image. We are streaming online. Don't go and see some pictures that I'm going to be some privacy issues. Okay, yeah, I've seen it. So I'm gonna reshare my screen so you see the pro forma for that. So I explained to you. I have to stop sharing and make sure that I get a file because some things are not for the online consumption. So let me do image. Give me a moment. I'm bringing it up. Let's see. This one. This one. Okay. Got it. Let's close this one. All right. So let me go back, share my screen with you. Wanted to just arrange it and bring it up here. Okay. There you go. I brought it up in my slide. So this is the operating statement using the absorption costing. And the reason why you compute this is the examiner may ask you to, after calculating all the ratios, you put it in a statement form. And we can do that under the absorption costing environment and also do that under the marginal costing environment in that case. So this is the pro forma for it. You bring your budgeted profit up. You bring your sales volume variance in that case. Then you bring your sales price variance. So you bring your sales volume and sales price variances. Then after that, all the cost variances that you've computed, you're going to be bringing it up in that particular situation. So that is the way we prepare the operating statement under the absorption costing. Then in the marginal costing, it's going to be almost the same, not almost the same thing. The reason is that in marginal costing, what's going to happen is that when it comes to the fixed overheads, you're going to calculate only the fixed overheads expenditure variance in that particular situation. You will not do anything like fixed overheads efficiency variance, fixed overheads capacity variance, and you have to know the difference between these two. So if you're in the marginal costing school of thought, you bring your budgeted contribution, you bring your sales volumes respectively, the sales variances respectively, then the variances that you computed will be coming up. Now, one thing you must know is that in preparing these statements, whether under marginal costing and under absorption costing, the statement must be reconciled with the actual results. So you're going to prepare an actual profit statement where you bring the actual sales actual material cost, actual labor cost, actual overheads, so that you can end up with actual profits. At the end of the day, the actual profit that you get there should be equal to the figure that you get when you prepare your variance analysis. When you prepare your operating statement in that situation. So that is what you need to understand about preparation of the operating statement under the marginal costing, and also under the activity-based costing in that case. And I'm going to be concluding around here today. And we wish you all the best. For those of you who are with me on Zoom, if there are any other things, you can send it to me on WhatsApp, and I could look out for you, or before tomorrow 9 a.m. certainly, in that case. And we wish you all the best as you go into the exam hall. Like we have said already, we've told you already, I mean, go for the cheap questions first. I mean, the theory questions that you can write on, go for it first. In that case, then you start with what you can do best first. I mean, don't go and attempt the question one first. I mentioned this to the FR students, but some people, I don't know, you like flex. I don't know if it is flex or swag, but I don't know. Question one, management accounting. Don't touch that question first. Go and answer the theories. All the examiner wants to know is number your questions well, period. So if it is question 1C, I and II, come and do it. Question 2B, I and II, do it on the next page. Make sure you number your answers, period. You don't necessarily have to take question 2 and answer everything in question 2. Darby, you want to make sure that you take the easy marks as fast as possible. Then from there, question 5B, all other things being equal, is going to be short-term decisions. And you want to find out what the heck is the examiner put in there for you. So you go there, you find out what is there. Variances, what the heck is there? You do it. There is variance there. Theory and calculation is waiting for you. There is budgeting, calculation or theory is there waiting for you. There is investment appraisal. Depending on how excited the examiner is, he can just jump on you with some theories and no calculation question. Don't blame him. Or he can decide not to bring anything on variance and on investment appraisal. In that case, you're going to have 2 questions on short-term decisions in that situation. It depends on whatever the examiner wants to achieve, because there are other subjects that has investment appraisal. So the examiner could decide that, and he has done that before. So he could decide that, hey, I'm not bringing any investment appraisal, but I'm going to dash you 2 short-term decision questions in that situation. So you want to make sure you take your time, read through the questions very well. Take your time, read through the questions very well, and start with what you can do best first. But just an advice, you can decide to take it or not. Question 1, don't answer that first. I mentioned that in the Air4 class consistently, every time. But there are people who still answer that question first and spend 1.5 hours on the console question. Now, if you've spent 1.5 hours on console question, I don't know how you are going to pass the exams. I don't know. Maybe we'll blow some magic on your scripts, then you're going to pass the exam. But stay away from questions. That's my recommendation. But you want to do whatever the heck you want to do. I mean, it's your own choice in that situation. So that is what I would say there. Whatever it is that we have to tell you guys, I mean, we've mentioned it already. So spend time, read the questions carefully. Management accounting English is different from the English you learned in the school. It's different from the grammar your teacher taught you. So read the questions very well. One word can change the whole story. So pay attention, take your time, don't freak out, don't rush, don't be nervous. Just take your time, read through the questions, understand, and start writing. Like I say all the time, you want to start thinking 45 minutes to stop work. If you start work and you start thinking, your chances of passing the exams, it's like this. So you want to make sure that you take all these into consideration. And we wish you all the best as you go into the exam hall tomorrow. And we will see you tomorrow for Wednesday's paper. as well. So I'll come your way tomorrow at 4:30 p.m. for Wednesday's paper. And we would be doing this till Thursday for the Friday final paper as well in that situation. So that is it. We wish you all the best and go in there and do what you can. And we pray that you will be able to sail through, and we'll see you next semester in some other subjects. So you take care of yourself and stay safe. Bye-bye.